The last situation that we want to look at with respect to the financial system is this two-way flow between financial intermediaries and financial markets. Notice that in all our other connections, securities were flowing one way from the demanders of capital to the suppliers of capital, regardless of whether they were going through the financial intermediaries or the financial markets. Capital was flowing the other way, from suppliers of capital to demanders of capital. And again, didn't matter if it was financial markets or financial intermediaries, the flow was going in one direction. Now when we look at the financial intermediaries and financial markets, we see two-way flows going on. Capital flows from financial intermediaries to financial markets, and it flows from financial markets to financial intermediaries. Securities, the same thing. Securities flow from financial intermediaries to financial markets, and from financial markets to financial intermediaries. Let's go through a couple of examples on that. One example might be a mutual fund. A mutual fund is a pooled investment portfolio managed by a professional portfolio manager, but held by a number of different individuals. It's a way for a lot of individuals to get exposure to the stock market and bond market without choosing their own individual stocks or choosing their own individual bonds. With a mutual fund, an individual that's not that familiar with stocks and bonds can still get exposure to those by pushing off the management responsibilities of the portfolio onto somebody that's trained to look at stocks and look at bonds, and hopefully will know what they're doing when they're making decisions of which stocks to buy, which stocks to sell. Mutual funds are very popular in our financial system because they do provide a way for individuals to get exposure to stocks and bonds, and a lot of individuals do not have the expertise or do not have the interest in spending the time to manage that portfolio on their own, to look through financial statements, to look through what the company is doing on a day-to-day basis and try to make the decision of what individual stocks or what individual bonds to buy. Mutual funds are a financial intermediary. Now, if I buy a mutual fund, decide to invest in a mutual fund, I might send the mutual fund company a check for $5,000. I would be a supplier of capital. That $5,000 is money that I want to invest for the future. I'm supplying that capital right now. So I send the money to the financial intermediary in exchange for shares of the mutual fund. The mutual fund company pools my money along with that of thousands of other individuals that are investing in the mutual fund and manages the portfolio. Sometimes they are going to be buying securities in the financial markets. They'll send capital up into the financial markets to buy, say, 1,000 shares of Exxon. That money will go over to the demander of capital, whoever's selling those shares, in exchange for the securities, which will then come back to the financial intermediary. Other times, the financial intermediary will be selling shares of stock. So if they're selling shares of stock, they're sending the securities up into the financial markets in exchange for capital. And that security now is flowing this way instead of coming down to the financial intermediary. Lots of examples of financial intermediaries engaging in transactions with the financial markets. For instance, banks purchase treasury securities quite often as a way to invest their capital. They turn around and sell those treasury securities at a later point, so banks engage with the bond markets, both buying and selling financial securities, so the securities and capital flow both ways in those transactions. Lots of other situations, for instance, a lot of mortgages that are issued by financial intermediaries are turned around and sold in the financial markets shortly after that. So we have a situation where we're looking at the financial system, and again, the purpose of the financial system is to move capital from the suppliers of capital to the demanders of capital as efficiently as possible. There are several ways that can be done. One is going through the financial markets, typically done for standardized homogeneous securities where there's lots of buyers and sellers. could go through a financial intermediary. Typically that's done for non-standardized securities where there aren't many buyers and sellers. May also be situations where the suppliers of capital have different risk return profiles than the demanders of capital, so that the demander of capital may be issuing a high risk long-term security to the financial intermediary. The supplier of capital may be getting a lower risk short-term security from the financial intermediary. We also see situations where financial intermediaries and financial markets interact with each other, sending securities and capital in either direction. A well-functioning financial system is critical to the overall economy, and one of the prime examples of that is the economic situation that we've seen in 2007 and 2008, where we've had one of the most severe financial recessions that our country has seen. A lot of people say it's the second worst since we've seen, or the worst that we've seen since the Great Depression. One of the big things that caused that severe recession is that at a certain point in September and October of 2008, we saw a situation where the financial markets just locked up. There was not capital flowing from suppliers of capital to demanders of capital, due to situations where risk levels got to be so high, liquidity problems came up. The suppliers of capital just did not want to supply money anymore. Financial intermediaries weren't able to work properly because they had so many internal problems. So demanders of capital were not getting access to the money they needed. If they didn't get access to the money they needed as a business, they had to cut back. Once they cut back on things that they were purchasing, then that ended up slowing down the overall economy. As the financial system starts operating more efficiently again, the economy tends to pick up a little bit. Now, a functioning financial system doesn't mean we don't see recessions. We see recessions all the time with a good, solid financial system. But when the financial system locks up, the recessions can become much more severe, and that's what we saw in the 2007 through 2009 financial crisis that we're starting to work ourselves out of at the time I'm recording this video.